Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and starting off this week once again with the big macro. So this last week we had the much awaited and much anticipated Fed interest rate decision. Not much of a surprise there. The Fed's holding rates as they were. No cuts as of yet, despite this whole Powell versus Trump narrative that's been shaping up in the media, with, Trump calling Powell a fool and putting, heaps of pressure in order to cut rates. But, I think all in all, it makes a lot of sense to wait, in my opinion. There's a lot of uncertainty right now as to what the economic implications of tariffs are going to be, right? So why prematurely cut rates just to appease the president or just to appease the stock market? And, I would actually go as far as saying that I think if Powell were to actually cut rates, the markets would not like it. The markets would not respond positively. And that's simply because it would seem like Powell is being pressured by the president rather than it being a independent strategic and economic decision as it should be from the Fed. I think if we also kind of tie in the interest rate decision to the data that we've been seeing, right, like especially in the labor force, it makes sense, right? It reaffirms and vindicates this decision to not cut rates. We see that initial jobless claims this week and continuing jobless claims both were less than what was expected or forecasted. And, it builds on this idea of resilience within the labor market that was also shown last week in the unemployment rate and strong non-farm payrolls that came out as well. I think on top of that, the other macroeconomic piece of news that I wanted to touch on was the 10-year note auction that happened this last week. Again, we saw pretty strong demand from both domestic and foreign investors, and this comes at a time, despite there being a lot of global tension, right? And what does this strong demand say, right? It says that there is still faith. There is still faith and there is still belief in the U.S. as a powerhouse. There is still reliance on the U.S. as an economy, and that global order is not going to change or be disrupted as significantly as many may have thought, during times of Liberation Day and the early days of tariffs, and, during all that uncertainty where there was a lot of chat about how, the world order is going to change and be disrupted. This strong demand follows from last month's strong demand, and I think, that's not necessarily going to change. And I think this reaffirms my idea or my thought and belief that the yield curve might actually flatten. The 10-year Treasury yield is going to come down, and the 2-year Treasury is going to rise and possibly even form an inversion if the economic implications of tariffs are start to hit in the coming quarters. But I think, with the strong demand that we saw from the U.S., I think another piece of news that ties in quite nicely is the trade deal or pact with the U.K., right? It's not fully solidified. It's still being worked on during the weeks ahead. But I guess the gist of it is that 10% tariff would remain on most UK goods, but UK steel and UK aluminium will be exempt from the US's 25% tariff, and UK car tariffs will be lowered to 10% from 25% for the first 100,000 vehicles. Now, what is the UK doing for the US in return? Well, UK is cutting tariffs on some US beef imports. That's going from 20% to 0. And the UK will also cut tariffs on ethanol. And Boeing came out a big winner from this deal, right? With a deal being struck with British Airways. But yeah, I think the crux of this is that discussions are still going on about the baseline 10% tariff, but that is yet to be hashed out. However, this is this is reaffirmation that deals are about to get done, right? Overall, we can see that progress is being made. Trump even teased a 80% tariff on China, which is a discount to the status quo of 145%. And that gave markets and investors some hope that more deals are coming soon. And I think we've reached a point in markets where everyone just wants stability. We've wiped out the losses. Well, the S&P has wiped out the losses of Liberation Day, and I think we're in for a good time if these deals can get cut. And we're in for a time of hopefully back to focusing on companies' earnings and fundamentals rather than the macroeconomic picture. But moving on to the important earnings this week, or ones that I would like to highlight, there are a couple companies this week. I think two of them are obviously very well known, and one of them is more for me than anything else, but one that I thought was of interest and of good value. But I'll start off with Palantir. When I was planning for this episode, doing research, I was thinking, how can one describe the price action of this stock, right? Like, it had a ripper of a year last year, and it has been amazing. It has done amazing this year. Right after earnings and after the bell, shares were down for Palantir about 9%, despite guidance being boosted. Then, in the subsequent days in the week, it climbs back up. So this kind of volatility has been the name of the game for Palantir. It's been kind of the overarching trend with this name. EPS came in exactly as expected, 13 cents adjusted. And revenue came in higher than expected, $884 million versus what was expected to be $863 million. That is up 39% year over year. Now, U.S. revenues for Palantir were up 55% year over year, and commercial revenues grew 71% year over year, while government segment sales jumped 45%. So these are strong numbers. These are strong growth numbers. The government segment growth was heavily attributed to greater U.S. defense sector adoption of its tools, right? And this is demand for LLMs and software supporting it has somewhat turned into a stampede, if I had to quote, Palantir's executive team. They raised their full year revenue outlook, which increased to between 3.89 and 3.9 billion. And this was from the values before, which were 3.74 billion to 3.76 billion. Stock has been up about 60% this year. It's been the best performer in the S&P. This is completely opposite to the trend from the larger tech companies, or even if you look at the NASDAQ, right? Like, this has outperformed significantly. Palantir boosted its adjusted free cash flow outlook as well for the year to be between 1.6 billion and 1.8 billion. And adjusted income for operations is expected to be between 1.71 billion and 1.72 billion. So, a lot of good stuff that they forecast on a forward-looking basis, right? I think a big driver was the number of deals they closed. They closed 139 deals totaling at least 1 million during the period. 51 of those topped at least 5 million, and 31 deals exceeded 10 million. So they're doing business, and they're attracting customers at a very, very fast rate, right? This has now become, in terms of valuation, one of the top 10 most valuable tech companies in the US. I do have to say, for all the good that this company has done, and I own Palantir for majority of last year. I sold it at when it touched about 74, and obviously sometimes now I think back and I could have made a good amount more, but when I look at the earnings multiple, I always feel a little better, because I understand that there was a certain level of rationale behind when I sold it and why I sold it. I mean, the earnings multiple is just insane. It is currently at a $281 billion valuation. It has overtaken Salesforce. And for context, Salesforce generated over 10 times more revenue than Palantir in the last year, and is expected to do so in the coming quarters as well. Palantir currently trades for 520 times trailing earnings, almost 200 times forward earnings, and about 90 times revenue. It's incredibly expensive. It's by no means a bad company. Alex Karp is an incredible CEO, clearly, but it's far from an ideal price to enter. And I know on X you see a lot of people talking about the Palantir wave, and it seems like people are freakishly bullish right now. But it's important to be able to, I guess, as investors, stomach the multiple and price you're paying for a company. And in my humble opinion, I think a multiple contraction is needed for Palantir, and it's overdue, surely. And I think that's going to happen at some point, because at this point, this company is priced for perfection, and there will come a time where it disappoints these lofty expectations, or at least that is what I believe. Moving on to the second company that I want to talk about, a very important company, a company everyone's obviously familiar with as well, especially if you're involved in the tech sector, AMD. Earnings were solid, right, topping expectations, and AMD also provided a strong outlook for the ongoing quarter. But stock reaction was ultimately not significant by the end of earnings because of the uncertainty around AI chip exports. I think at some point it was up about 4%, and then it was down slightly from where it started. So I think this uncertainty has kind of been the theme for a lot of companies reporting earnings. For AMD, results were earnings per share came in at 96 cents adjusted, versus what was expected to be 94 cents. And this is obviously being expectations. Revenue came in higher than what was expected, came in at 7.44 billion versus an expected 7.13 billion, growing 36% on an annual basis. The company reported net income of 709 million versus net income of 123 million a year ago. So a phenomenal jump. And for the current quarter on a forward-looking basis, AMD mentioned that they expect about 7.4 billion in sales, with a gross margin of 43% versus Wall Street's estimate of 7.25 billion in sales. AMD is the closest competitor to NVIDIA, right? And we know this. They are the closest competitor to NVIDIA for the big GPUs, so the kind of chips and GPUs that are deployed in data centers and AI infrastructure. So the data center segment for AMD came in at $3.7 billion in sales, which topped consensus estimates. This is up 57% year over year due to demand for both its EPYC processors and Instinct GPUs. We have seen with big tech that they're spending, right? So it's no surprise that this segment is up the numbers that they are up, 57%. And Lisa Su just confirmed what big tech earnings taught us, that infrastructure spending is continuing. It's expected to continue. There's not been a slowdown because of tariffs or whatever geopolitical issue. These companies are continuing to spend. She mentioned the use of AMD chips to train AI, right? Inference, which is what they call it, and that doesn't seem to be slowing down in this global race of AI domination. The other major segment of the company, which is client and gaming, and this includes chips for consumer devices such as laptops, gaming PCs, and game consoles. That segment was up about 28% from a year ago. However, breaking that down a bit more, gaming revenue was actually down 30%, which is kind of what was expected, while laptop and PC chips revenue were up 68%. So I think, looking at their earnings, a large takeaway for me from this entire report was the mention of a $1.5 billion hit on an annual basis to AMD's revenue. And I think that's also what the market reacted to, right? Like subsequently. And this $1.5 billion hit is due to restrictions with China sales and export controls, right? And I think, yes, this is going to affect both NVIDIA and AMD. I'm yet to do my research, but I think NVIDIA has found a way around it in some capacity. But this is going to affect companies, and there have been rumors, of course, that Trump plans to rescind Biden's export curbs on AI chips, and AMD and Nvidia reacted positively to this news, but obviously this is going to be replaced with something else, and we're just unsure what that is at the moment. And I think, as I've mentioned before in this podcast, markets hate uncertainty. Bad policy is better than unknown policy, and I think that's the fundamental driver in terms of how companies are valued and priced, right? People need probabilistic confirmation on certain events, numbers, for them to have faith in their intrinsic fair value of a company. But that said, I think AMD sits at a very fruitful spot right now in AI infrastructure development, and where chip manufacturers and chip designers and all these semiconductor companies sit. AMD and Nvidia are two companies that I think are just worth holding if you've bought them before and you have them in your portfolio. There's no rush to sell either of these, because I think right now, obviously, Nvidia is just steamrolled ahead as a leader, but you always expect competition to catch up at some point, right? And AMD has overtaken Intel in many ways over the last few years, and I think their growth trajectory is expected to continue. So I think it's definitely a company to hold on to. It's hard to pick between AMD and Nvidia, right? You're picking between first and second, or second and first in this case, but I think it's important to understand that there can be multiple winners in each segment, and it's important to understand the value proposition of each, right? And AMD definitely positions itself as a company that can offer chips for cheaper than Nvidia. I mean, Nvidia has had pricing power that nobody else has had in this space, and I think AMD are obviously trying to disrupt some of that supposedly monopolistic behavior. I don't actually think Nvidia is a monopoly, but they're supposedly trying to disrupt some of that behavior. Now, with that said, I'm going to move on to the last company that I want to talk about. A very interesting one. It's called Coupang. Now, first and foremost, for those that don't know about Coupang, it's essentially, as a way to say it, the Amazon of South Korea. Right, the company operates primarily in South Korea, but also has some international presence, Taiwan namely, but there are some other countries that it operates in terms of operations. But, I know this theme of the Amazon of, right? You have the Amazon of Brazil, which is Mercado Libre. You have the Amazon of India, which is Flipkart. You have the Amazon of Southeast Asia, which is Shopee. And here we have the Amazon of South Korea, which is Coupang. So they're known for end-to-end integrated fulfillment, logistics, and technology network, which enables rocket delivery. Right, that's what they call rocket delivery, which provides essentially free next-day delivery for orders placed any time of day. Right, this could be even seconds before midnight, and this is across millions of products in Korea. So it's very much, rocket delivery is very much like having an Amazon Prime subscription. They call it a Rocket Wow membership. So how does Coupang make money? They own and operate e-commerce businesses through mobile and internet, and they have two main segments, product commerce and developing offerings. That's what they call it in their financial statements and press releases and filings. So product commerce essentially includes core Korean retail and marketplace offerings. So this is owned inventory and third-party merchants. It includes Rocket Fresh, which is their fresh grocery category offering, as well as advertising products associated with these offerings. Right, revenues from product commerce, well, this segment primarily derived from online product sales of owned inventory to customers in Korea, commissions and logistics and fulfillment fees, which are earned from merchants that sell products through their mobile application and website, and obviously from their Rocket Wow membership, which, as I mentioned, is very similar to having Amazon Prime. Their developing offerings, which is their second segment, includes the more nascent offerings and services. This includes Eats, their restaurant ordering and delivery service. It includes Play, their online content streaming service in Korea, fintech, and their retail operations in Taiwan, as well as advertising products associated with any of these offerings. This segment also includes Farfetch. Now, Farfetch is a standalone company. It's a global marketplace for luxury fashion, which was acquired by Coupang in January 2024. So I'm not sure if people have used Farfetch before, but basically it's an app or website where you can buy luxury fashion on a marketplace. So revenues from this segment are primarily generated from luxury fashion marketplace through Farfetch, the online restaurant ordering and delivery services in Korea, and retail operations in Taiwan. So moving on to Coupang's earnings, now that we know a bit about the company, earnings were solid for the first quarter, and the stock was up about 9% by the end of this week. It's been up about 23-24% over the last month as well. Revenue came in at $7.9 billion, which is up 11% from last year first quarter. Net income came in at $107 million US. This is up by $102 million from first quarter 2024, and profit margin was 1.4%, which is up from 0.1% same time last year. So this increase in margin was driven by higher revenue predominantly. Earnings per share came in at $0.059 US, which is up from 0.003 in first quarter last year. Now, revenue missed analyst estimates by 1.4%, but EPS exceeded analyst estimates by 9.7%. So profitability over top line growth, which is very, very impressive for them to be managing their costs as well as they have done so. Key strategic initiative, I think, recently from Coupang was the launch of something called Rocket Pitch, which is a new program launched in partnership with the U.S. International Trade Administration, aimed at helping U.S. companies pitch and sell their consumer goods in the South Korean e-commerce market. So this comes at a very important time, right, with tariffs and this idea of deglobalization and nationalism that's coming out to continue global trade. This is Rocket Pitch is a pretty incredible new program and a very timely initiative from Coupang, which I think is going to definitely help their business. Analysts predict revenue will continue to grow at about 11% annually, and the international expansion as well as reinvestment into their business with AI and logistics capabilities, in my opinion, is going to position it for success. Now, the analysts have a price target of $29.79. Coupang is still trading at a discount. Last I checked, it was about 25.7. So, it's definitely an interesting company. It seems to be at some sort of inflection point here, doing some pretty cool things strategically. They're growing in Taiwan. A lot of success and growth is priced in. It's not a cheap company. It's currently got a market cap of about $47 billion. But, future prospects look pretty exciting. Expansion capabilities, growth prospects, it all looks good. And, I say this especially if the company can gain more traction outside of just South Korea. It is a company I'd probably want to do more research on going forward, but it's one for my watch list and definitely an earnings that I thought was worth sharing and looking into. Now that wraps up today's episode. I'd like to remind you guys that obviously none of this is formal investment advice. This is all purely for educational and informational purposes. So with that, I thank you all for listening. I'm Anurag Birla, and this is the Finance Now podcast.